There is a narrow window every single year, the last few weeks of December, where a handful of decisions permanently lock in or permanently lose thousands of dollars in tax deductions. Miss the window, and there is no filing an amendment later that fixes it. The deduction is simply gone. Most pre-retirees think of tax deadlines as an April problem. That's the trap. By April, the year that matters is already over. The moves that actually change your tax bill, charitable giving strategies, health savings account contributions, required minimum distribution timing, tax loss harvesting, almost all have to happen before December 31st, not before tax day. Today, I'm walking through the specific deductions and moves that expire at year end, a real example of what missing them costs, and the exact checklist to run through before the calendar turns. The IRS gives you until mid-April to file your return and pay what you owe, but the transactions that determine what you owe, what you contributed, what you donated, what you converted, what you sold, are locked in based on the calendar year, not the filing deadline. Once January 1st arrives, last year's window for most of these moves closes permanently. Required minimum distributions. If you're 73 or older, your RMD must be withdrawn by December 31st, with one exception for your very first RMD year. Miss it, and the penalty is steep. 25% of the amount you should have withdrawn, reduced to 10% if corrected quickly, but still a real cost for a missed deadline that has nothing to do with April. Charitable contributions, cash, checks, and charged donations must be completed by December 31st to count for that tax year. A check dated December 31st, but not mailed until January doesn't count for the prior year. The IRS looks at when it was delivered or postmarked, and disputes here are common and rarely resolved in the taxpayer's favor. Qualified charitable distributions. If you're 70 and a half or older, you can direct up to $105,000, a limit that's indexed annually, directly from your IRA to a charity, which satisfies your RMD without counting as taxable income. This has to be processed by your IRA custodian and received by the charity before year end, and custodian processing times in late December can run 1 to 2 weeks, meaning waiting until December 28th is often too late. Tax loss harvesting. As covered in a previous video, offsetting gains with losses only works if the sale settles by December 31st. Trade settlement can take 1 to 2 business days, so a trade placed on December 31st itself may not settle in time. Health savings account contributions. Unlike IRA contributions, which you can make up until the tax filing deadline in April, employer-based health savings account payroll contributions typically must be adjusted before the last payroll of the calendar year. Check with your HR department, because the window closes earlier than most people assume. Pre-retirees are often juggling multiple year-end moves simultaneously: an RMD, a Roth conversion, a charitable gift, and portfolio rebalancing. And the paperwork processing time for each one competes for the same narrow December window. Custodians get backed up. December 20th feels early. It isn't. A 74-year-old pre-retiree with a $40,000 RMD obligation decides in mid-December to use a qualified charitable distribution to send $20,000 directly to charity, reducing their taxable RMD income and satisfying part of their obligation tax-free. They contact their IRA custodian on December 22nd. Between processing time, the custodian's internal cutoffs for guaranteed year-end delivery, and the holiday schedule, the distribution doesn't reach the charity until January 3rd. Because it wasn't received by December 31st, it doesn't count as a qualified charitable distribution for that tax year. The full $40,000 RMD is now taxable ordinary income instead of $20,000. At a 24% marginal rate, that's an extra $4,800 in tax, solely because of an 8-day processing delay that could have been avoided by starting the request 3 weeks earlier. Move 1. Build your year-end checklist by Thanksgiving, not Christmas. Every move that has a December 31st deadline should be initiated by the 3rd week of November at the latest. This gives custodians, charities, and brokers enough buffer to process requests even with holiday delays. Move 2. Confirm your RMD is satisfied with a written custodian confirmation. Don't assume an RMD is complete because you initiated the withdrawal. Get written confirmation the funds have actually been distributed. Initiated and completed are not the same thing in the eyes of the IRS. Move 3. Front-load charitable and qualified charitable distribution requests to early December. If you're doing a QCD or a significant charitable gift, submit the request in the first 2 weeks of December. This builds in enough buffer for custodian processing, charity receipt confirmation, and any unexpected delays. Common mistakes people make trying to avoid this. Mistake 1. Waiting until the last week of December to check the box on multiple deadlines simultaneously. Mistake 2. Assuming a postmarked check counts even if mailed on December 31st with no tracking or confirmation. Mistake 3. Not confirming with the custodian in writing that a QCD or RMD was fully processed, not just requested. Here's your action item this week. Pull out a calendar and write December 31st in bold. Then work backward. If you have an RMD due, a QCD you want to use, a charitable gift you're planning, or losses you want to harvest, mark a deadline of no later than December 15th to have every one of those requests submitted. Not just planned, submitted. The checklist. Confirm your RMD amount and get written confirmation once distributed. Submit any QCD requests by the first 2 weeks of December. Complete charitable contributions with confirmed delivery, not just a postmark. Place any tax loss harvesting trades early enough to settle before December 31st. Check with HR on health savings account payroll contribution cutoff dates. The IRS calendar doesn't bend for the holidays, and neither do custodian processing times. The people who lose these deductions almost never lose them on purpose. They lose them because they treated April as the deadline instead of December. If this helped, subscribe. Every week I cover a new IRS trap, Social Security tax mine, or retirement account landmine before it costs you money. I'm May. See you in the next one.